Hi, I'm Josh Jampedro with Home Loan Advisors, and today we're diving into a topic that holds a significant key in your mortgage journey: your credit score's impact on your mortgage rate. I'm here to explain how this three-digit number can influence your mortgage interest rate and your overall borrowing experience. Think of your credit score as a grade for your financial responsibility, like a report card for managing your debts. Credit scores usually range from the 400s to about 850, and the higher your score, the better your financial reputation looks to mortgage lenders. Lenders use your credit score to assess the risk of lending you money. A higher credit score indicates lower risk. And interest rates, in a nutshell, are a reflection of risk. And so your credit score has a direct impact on the mortgage rate that your lender offers you, because your credit score is generally looked at as an indicator of how risky it is to lend you money. Higher credit scores tip the scales in your favor. Lenders are more likely to offer you lower interest rates because they see you as a more responsible borrower. On the other hand, if your credit is lower, lenders might offer you higher interest rates to account for that perceived risk in your credit. So what's considered good credit? What's bad credit? How does this generally affect your rate, kind of in specifics? So generally, excellent credit is considered to be about 740 and above. So with this score, for example, you might be offered, let's say, a 4% interest rate on a 30-year mortgage. Good credit, on the other hand, is between about 700 and 739. And in this range, you might see a slightly higher interest rate, maybe somewhere around 4.25%. So only about 0.25% higher, but that definitely starts to affect your monthly payments, although not a lot yet. But you can see that kind of incrementally increasing and how that might hurt your mortgage payment. Fair credit now is maybe between 660 and 699, and you might see something like a 4.5% rate if your credit is in that range. Low credit, kind of the other end of the scale, is below 660, and now in that range you might be looking at 5% or more. And so you can kind of see here how, even though little individual changes in your credit might not have a huge impact, as they start to add up, you can see a pretty significant impact between somebody at 4% who has like a 750 credit score, and somebody who's 100 credit points lower at 650, all the way at 5%. And overall, that difference in score can certainly impact your payments, impact the amount of interest that you pay over the life of the loan. So not only does your credit score impact the interest rate that you have, it also means that there could be additional requirements necessary to prove your creditworthiness to that lender. It could mean that you're not able to get a loan entirely. They may just flat out deny you if your credit score is not high enough. Or if you're kind of in the lower range, you might have to prove that you've paid your rent on time. You may just have a few more requirements that somebody in that 700 or 800 bucket might not have. But there is good news. Your credit score isn't set in stone. There are steps that you can take to improve it. Paying your bills on time, removing your monthly debts, reducing your monthly debts, and avoiding new credit inquiries can generally boost your score over time, leading to better interest rates on your mortgage. Your credit score isn't just a number, it's a powerful tool that impacts your mortgage rate and your financial future. And by understanding its significance and taking proactive steps to increase your credit score, you'll be better positioned to secure favorable interest rates and terms for your mortgage. If you have any questions, feel free to reach out to me. Mortgages are complex, so make sure you have an experienced home loan advisor on hand to help you make the right decisions. Thanks for watching.